This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So this is episode 5 of the Rational Reminder Podcast, and we thought we'd take a second just to talk about who we are and why we're doing the podcast, just for any new listeners that may not have heard our introductory
Just
episode.
amazing. This is the 5th one already. Time just screams by.
Well, we're doing one a week, 5 weeks, a little bit more than the month that we've been recording episodes.
And you mentioned it in the newsletter last week, right?
Yeah, that was, we talked about in our last episode how we've gotten some good feedback. We did push it out in our Rational Reminder newsletter to a couple thousand people, and a lot of good feedback came back from that.
I'd love to have questions as well so we can answer listener questions.
Yeah, definitely. So Cameron and I, just as a real quick introduction, we both work for PWL Capital. Cameron is a portfolio manager. My title here is Associate Portfolio Manager. Cameron's been in the financial services industry for
27 years almost.
27 years.
Yeah.
And I'm going on my 7th year in the industry.
Yes, you were
Seems
2
like
or
a-
3 when I started.
Seems like a long time to me.
So last episode or 2 episodes ago, you mentioned you were looking at cars. Any
Yeah,
on
so
that?
we looked at we're leasing a new Subaru, which we're going to do. Just test drove it. Pretty awesome. For anyone listening that doesn't know me in person, I'm just about 7 feet tall, so it's not always easy to find a vehicle. But I was actually amazed at the legroom in the Subaru Ascent. So that was a nice surprise. That was my biggest concern, was that I wasn't going to fit in it.
And also, people who don't know you should know that you're not the biggest fan of debt.
Yeah, I mean, I don't have a ton of debt. I've been lucky. I paid for school with athletic scholarships, so I've never had to take on any student debt, and I'm a renter.
So leasing a vehicle is a whole new thing for you.
Well, yeah, it's kind of like rent, I guess. They're both sort of debt. It doesn't show up in the balance sheet as debt, but still an obligation.
So, I mean, we had a lot of feedback about leasing versus buying, and it got me to think that as you go through the leasing process, you have to, or the dealership will do a credit check on you. So recently I helped a friend check their credit out. They didn't know what their credit rating was, never thought to check on it, had no idea, heard about it before, but didn't know how you do it. And so I was showing them how easy it is to use an app called Credit Karma, so Karma with a K. Super simple app. I know you do yours regularly.
Yeah.
And I've done mine a number of times. And in fact, it updates you monthly what your score is.
I think it's weekly, actually.
Is it weekly?
Yeah.
So I know mine, it tells me when I go in, it says it will be updated on whatever the 15th of the next month. So it's an interesting statistic to see. It matters a lot. And you can also go through and see your complete credit history. Any credit card you've had, any line of credit, any sort of debt at all shows up on this list.
Yeah, I check it every week. I check it mostly for fraud detection, just if somebody opened a credit product in my name. My score doesn't change that much week to week, but just checking to see if anything's changed in my credit file, I find to be pretty helpful. Makes me feel good anyway.
It also, like mine has a spelling mistake. There is an entry with a different spelling of Cameron, so I see there's 2 different people linked to that. So it is a good way to check to see if anyone else is taking advantage of your credit at all.
The other thing that's really cool about it is that it shows you bit by bit why your score is what it is. And for me, that was really helpful in learning the different things that you can do to improve your credit. So stuff like minimizing your credit utilization. So that's like I think it's around 30% utilization is where you start to get in trouble.
30% of
your total available credit.
Credit.
If you're using that at any time.
Opening up extra credit cards also hurts your credit rating too, doesn't it?
So if you get a hard check, that means if you go and open up a credit card, they do a hard check on your credit file.
Yeah.
That reduces your score because creditors will start to wonder why you're applying for so many credit products. But if you do have multiple credit cards or multiple credit products, that can improve your score. So having a good mix of credit products, like having credit cards, lines of credit, maybe a vehicle loan, having that mix is viewed as a positive thing. So if you go and apply for 17 credit cards, that's going to hurt your score. But if you have a credit card, a line of credit, a vehicle loan, that helps your score. But the big thing is the utilization. So if you have a credit card with a $5,000 limit and for most of the month it's at $4,000, your credit utilization score is very high, and you're going to get dinged for that. So a couple things you can do is you can pay off your credit card weekly, pay off the balance weekly, or you can open more credit products. So if you have a $5,000 limit credit card
Right.
and a $20,000 line of credit, even if you never use it, your utilization is going to be lower.
I know mine. I missed a payment for a very small amount, like $50 or something, when Costco switched over to the MasterCard. And I just forgot, and I was on an email with an old email address or something, so I completely missed it, but it was a very nominal amount. And I know after that, my credit rating went down.
Oh, yeah.
Yeah.
Yeah, it definitely would. I have all my credit cards set up for automatic payments.
Shocking.
Like I use the Tangerine. I use the Tangerine credit card, and it pays the full balance every month. I don't even use I had the Capital One, the Costco one, like after they switched from Amex.
Yep.
I don't even use it anymore because for some, like they have automatic payment available, but for some reason the Tangerine bank account is too many digits to fit in there. And there's no, like I tried calling them, they can't fix it. So I just don't use it because I'm like, it's not automated. I'm not
You're not going to use it.
I'm not going to risk missing a payment if I forget about it.
So speaking of credit, you're working on a new blog post this week, which was fascinating, complicated, but fascinating, talking about mortgages. So a question we get all the time is people have homes, mortgages, and a portfolio. Should I pay off the mortgage or should I leave it invested? Should I borrow against the equity of my house and invest? And you've done some really interesting analysis on this. So I think it's worth slowly explaining this to clients and to listeners so that they can get a grasp of kind of the metrics and rules of thumb around this.
Yeah. So it is a bit complicated, you're right. And we'll do the best that we can to talk through it. But as you mentioned, the question is, do I keep my portfolio intact and leave my mortgage as is, making the regular payments to pay it off over whatever it is, 25 years? Or do I take a big chunk of my portfolio and use that to pay off the mortgage all at once and just be done with it? So this is something that we talk to people about.
Now, your analysis assumes there's no emotional biases. Like some people are hardwired to want a paid-for house. Other people are hardwired to have as big a portfolio as possible. So you're ignoring that. You're just applying pure, straight mathematical logic to the decision.
Yeah, that is what it is. But now you say that. I've had this conversation with clients, so this is the first time I've written about it, but I've been thinking about it for a while. I'm talking to clients about it for a while. And every time that I've told someone, it might just make sense to pay off your mortgage, I've not had one person say, oh, that doesn't sound like a good idea. People like actually jump. Really?
Behaviorally, people love it. Like a paid-for house.
Yeah. So anyway, the advice that I think is sort of standard across the financial services industry, but it's also kind of the common thinking that I think people have about this question. And that goes, the story is that because you probably have a higher expected return on your portfolio, you should leave your mortgage as is, pay it off with the regular mortgage repayment schedule so that you can keep as much money as you can invested in a portfolio that has a higher expected return. Now, that's true even with a conservative portfolio. Like if we think about a 50% stock, 50% bond portfolio, the expected return is still going to be higher than what you're paying in mortgage interest.
Definitely.
So that argument seems very logical, but it's a little bit more complicated than that. It requires thinking about detaching the mortgage debt from the house asset. So we want to think about the mortgage and the house as one package and the portfolio as another completely separate package.
Well, people are totally comfortable having a mortgage on a house.
That's right.
Whereas most people are not comfortable having a debt attached to their portfolio.
But there is pretty well, other than maybe some rules around how margin debt works versus how mortgage debt works, there's really no difference. It's debt, and it's on your balance sheet.
Right.
Whether it's attached to the house or the portfolio, it doesn't really matter.
Right.
other than stuff like margin calls, which you don't have with a mortgage. But if we eliminate that as a difference, there's no difference between mortgage
Because
debt.
if you have a paid-for house, you can still go and mortgage it and take the proceeds and invest.
That's right. So
which makes it interest deductible.
That's correct. Right. Right. So if you make the decision, well, hey, I've got all this cash that I could use to pay off my mortgage, but I'm going to choose to keep my mortgage and invest. If you decide to do that, then there's the thing called the Smith maneuver, where you do that. You go and pay off your mortgage with the cash that you have.
Sell your portfolio, pay off your house.
Correct.
Borrow that amount back,
right.
And invest.
So then take a home equity line of credit against the house, and now it's no longer a mortgage. Now it is a loan for investment purposes,
right.
Which makes the interest tax deductible. As long as you have the intention of earning income, which is a bit of a gray area, I guess, when you're talking about ETFs and mutual funds. But anyway.
So let's do a real example.
Yeah, so we'll walk through an example. If we take someone, we'll just imagine a person, and they've got a $500,000 home with a $400,000 mortgage, and they've got a $900,000 investment portfolio that's invested in a mix of 50% stocks and 50% bonds.
So net worth is $1 million. You have $100,000 of net home equity, $500 value, $400 mortgage, and a $900,000 portfolio.
Correct. So their net worth is $1 million.
Okay.
Now, they're in a position where they can make a choice. They could choose to keep the mortgage, kind of like what we've been talking about, continue making payments with their employment income or whatever income source that they have, and leave their portfolio invested. So that's option one, which is, I think, what most people think is the smart option. Option two is that they could sell $400,000 of their $900,000 portfolio and use that cash to pay off the mortgage completely. Now, there are a couple details that we're going to ignore. So to pay off a $400,000 mortgage in a lump sum, there would probably be penalties.
Yep.
To sell $400,000 of the portfolio, there would probably be tax implications. But we'll just ignore that for the sake of the example. And
so in that example, you end up with a $500,000 portfolio and $500,000 home.
Right. So net
fully
worth
paid for.
Net worth
still $1 million.
Still $1 million. Exactly the same. Now, if we fast forward 1 year, so we think about those two options, and we fast forward 1 year, it's going to look a lot more attractive. The net worth of this person is going to be higher if they keep the mortgage and the larger portfolio. So we're assuming a 50-50 portfolio on both sides, one side with the mortgage, one side without. 1 year later, the larger portfolio and the mortgage is going to result in a greater net worth than the smaller portfolio and no mortgage.
Expected, not guaranteed.
Right. Right. We're assuming an expected return for the portfolio.
Yep.
And the reason for that is simply that because the $900,000 portfolio is earning a higher expected return than the cost of the mortgage, you're getting that delta between the mortgage cost and the expected return on the $400,000. Whereas on the other side, with the $500,000 portfolio and no mortgage, you're not getting that additional growth. So I think that's the common way to think about it. Do you agree?
For sure.
So I think the problem is that's not an apples to apples comparison. If we think about the $900,000 portfolio, only $500,000 of it is your own money. The rest is the mortgage debt. So that's kind of what we were talking about, detaching the mortgage from the home and just viewing it as part of the overall balance sheet. So the $900,000 portfolio is really employing 45% leverage. Now, if we told someone to do that with a margin loan, they would think that we were nuts. Mm-hmm. But with mortgage debt, 45% leverage, somebody's perfectly comfortable with. Now, another way to think about this, and I think it's a decent way to think about it, is that so that $900,000 portfolio is 50% stocks, 50% bonds. So $450,000 in stocks, $450,000 in bonds. Now, the 45% leverage is kind of like being short bonds.
Right.
So if you're short bonds and long bonds at the same time, you have no bond exposure.
Net zero bonds.
Right. Now, in this case, it works out that...
Because you own bonds on one side and you owe someone money on the other side, which is effectively a bond owned by the bank.
Right.
Effectively.
Right.
They cancel each other out.
Right. So you've lent money to a company, so you've bought bonds on one side, and you've sold bonds on the other side. So you're net neutral in the fixed income portion of your portfolio.
Right.
So now we've got this $900,000 portfolio with 45% leverage, and that leverage is really just offsetting your fixed income exposure.
Exactly.
So while it looks like in your statement, in your account statement, it looks like a 50-50 portfolio, it's really more like a 95% equity portfolio, 95% equity, 5% fixed income. That's scary, I think, to people to say, well, I've got a 95% portfolio, but they would never view it like that because that's not how it shows up on the statement.
Therefore,
so if we rewind and go back to the example that we just laid out with those two decisions, and we compare the 50-50 portfolio with the mortgage, just like exactly the same example that we talked about before, but on the other side of the example, where we're paying off the mortgage, if we, instead of keeping the 50-50 portfolio,
and a paid-for house.
And the paid-for house, so no mortgage, if in that side of the example we increase the equity allocation to 95%, and then we again fast forward 1 year based on some expected return assumptions, the net worth ends up being exactly the same. So now on one side we've got a larger portfolio and a mortgage. On the other side we've got a smaller portfolio, no mortgage, but we're also taking more equity risk.
So do you think clients would be able to withstand more volatility with a paid-for house? A bit of an emotional question going on there too, I think.
It's a very emotional question. And I mean, that's not a question we can answer. That's a question
I think absolutely. If you have a paid-for house, I think emotionally people would be able to withstand more volatility.
Yeah, and even if you think about it, and you're going to laugh at me, if we don't think about it from an emotional perspective, if we think about it from a sequence of returns, Monte Carlo type perspective, if you've got a paid-for house, you no longer have those cash flows going out. You're no longer short fixed income.
Yep.
So you've actually decreased the risk of your situation, and you can withstand more market volatility because you're withdrawing less from the portfolio.
Exactly.
Well, I guess that's assuming they're retired. If the debt payments are coming from income, it's not as much of an issue, although there is still human capital risk. But anyway, we could go down a long rabbit hole with that. So now, in line with what we were just talking about, if someone is listening to this example and says, well, geez, I would, I'm about to retire, or I'm 10 years away from retirement, I would never be in a 95% equity portfolio, I think it helps to think about it another way. So in both cases, you've got a $500,000 home. So you've got $500,000 in real estate, which you own. You also, right, that's that piece of it. Now, if you're keeping the mortgage and investing $900,000, that's, as I mentioned before, effectively investing $500,000 of your own money and borrowing $400,000 as a mortgage. So you've got this leveraged investment. Now, if we think about that leveraged investment, in the worst 12 months of the financial crisis, a 50% stock, 50% bond portfolio lost 20.58%. So that's a big drop, but not nearly as big as a more aggressive portfolio. So a $900,000 portfolio in the financial crisis lost $185,220. In our example, only $500,000 of that $900,000 portfolio is your own money. So if we take a $185,220 loss on a $500,000 investment, which is what you've made because the rest is not your money, that is a 37% loss. So it's not really a 20.58% loss like you'd have on the portfolio. Because you're investing less of your own money, it's actually a 37% loss. And you paid 3% interest on your $400,000 mortgage. So your total loss in 08-09 with this leveraged portfolio ends up being a little bit more than 39%.
So interesting.
Right.
So the loss is basically the same.
Well, that's the thing. So now the alternative is what we're talking about is owning the 95% equity portfolio, which is what I think people would think is scary. So if you own that portfolio through the financial crisis, you lost 38.92%, and you had no additional interest costs. So as an investor, as a rational investor, and I know behavior is important, but as a rational investor, you should be almost indifferent between the two situations with a slight preference for the riskier portfolio because it gives you a slightly better outcome and does not have that guaranteed interest cost.
But if someone came to you with a paid-for house and a portfolio, would you let the fact that their house is paid for drive partially their asset mix? I really had that conversation with someone. It makes you think that perhaps you should.
I think
because in this case, you're saying, oh, because you have a mortgage, you can take on more risk. But if someone didn't have the mortgage, would you say you should take on more risk? Because that's really just a shell game we're doing here.
We talk about it with pensions, right? If we say someone has a pension, they've got a guaranteed income. then part of the conversation is often, well, you could take more risk if you wanted to because you have this guaranteed source of income. Owning the house is not quite the same because it's not cash flow coming in, but it's also security that you're not going to have cash flow going out for housing costs.
Yep.
So at the end of the day, owning a house and having a pension from a cash flow perspective is pretty much the same thing.
Yep.
So in either case, I think you could justify a higher equity allocation.
And you're right. Who doesn't want a paid-for house? So I very interesting. Great blog post coming out next week, I believe.
Yeah. Yeah. So I think at the most basic level, the takeaway is that if you have a portfolio that is not 100% invested in stocks, and you also have a mortgage, it probably makes sense to at least give consideration to the idea that, hey, maybe I should it's kind of like taking the fixed income out of your portfolio and using that to pay down a chunk of your mortgage. So you end up with a riskier portfolio, less mortgage debt, but your expected return stays the same or even slightly improves, with the added bonus that you no longer have that guaranteed interest cost.
Yep.
Yeah. So anyway, I think it's an interesting discussion that we've been having more and more ever since we learned about this way of thinking, which I think is pretty interesting.
So what do you want to cover next?
I mean, it's kind of old news these days, but the idea that we might be in a tech bubble keeps coming up with evaluations of.
Yeah, I know. Pat, Nick, and Carlson talk about this a lot on their podcast. Almost every week they're talking about it on the Animal Spirits podcast.
It's hard to miss. It's hard to miss, really.
It's really a non-story.
Who knows? I mean, it's historical, I guess, in the sense that a company reached $1 trillion in valuation, but yeah, I don't know. I saw a really interesting stat on Twitter. I did not take a note of who tweeted it, so I apologize to whoever that was, but during the dot-com bubble, Microsoft had a market cap of $605 billion. And if we adjust for inflation to today, that is very close to a $1 trillion valuation. Its price-to-sales ratio at that time was 32. Today, Apple has an actual market cap of $1 trillion, and its price-to-sales ratio is 4.
Mind-boggling.
Yeah.
Boggling.
Crazy. If the same price-to-sales ratio applied to Apple today as it did to Microsoft in 1999, so that's that 32, price of sales of 32, then Apple's valuation today would be $8 trillion. Now, obviously, that was tech bubble time. So that's not the same situation as today, or we hope anyway. Yeah, and the other thing that's been talked about a lot is the valuation, the price to earnings of the S&P 500 and how the price has gone up so much since the financial crisis. How can it keep going up? And I saw some really interesting stats on the returns of the S&P 500 for the last 10 years. But the fundamentals have been backing that up. So while returns have been about 10% a year, dividends have also been increasing about 10% a year, and earnings have also been increasing about 10% a year. So yes, we're in a bull market. Yes, prices are going up, but the economy is also doing really well. Companies are actually doing well, and that's one of the reasons the prices have been going up. Yeah, so those are some interesting stats to talk about.
But as you said last week, the big companies in the S&P 500, so Facebook, Apple, Alphabet,
Netflix,
those are the big ones. The percentage they represent of the market is not out of kilter with historical norms. It's
Correct.
in that 15-16% range, which is totally normal.
Correct, in terms of market cap. One of the I saw, and I haven't dug into this at all, but I saw a New York Times article talking about profitability concentration. So now we're not just talking about market cap, but it's like the concentration of profits, corporate profits are getting more and more concentrated. And that has some interesting implications for wealth equality and all that kind of stuff that like I said, I didn't dig too much into that story. I skimmed it and it didn't seem actually too exciting. Raymond, our PWL Capital's director of research, sent me a pre-copy of a really, really interesting analysis that he does every year.
A bit of a teaser.
Yeah, it is, I guess. I don't know if he's going to publish it or if he's going to use it to teach his course. But anyway, he sent
Miguel.
he sent me an advanced copy. So he looks at the largest Canadian institutional investors. So these are all huge pension funds, CPPIB, OMERS, HOOP, PSPIB, OTPP, CDPQ, and BCI. So lots of acronyms, but those are all the largest pension funds. Like
Canada Pension Plan, Ontario Municipal Employees, Hospitals Ontario, Ontario Teachers Pension, the Caisse de dépôt in Quebec, the BC Pensioners, I believe.
Yeah, I didn't dig into.
There's one of Alberta, the Pension of Alberta.
Yeah. So they're huge. And when we say huge, they have 1.4 trillion Canadian dollars in assets. That's more than the whole entire Canadian mutual fund industry. So it's a serious amount of assets. The average 10-year return of all of those pension funds together, 6.4%. Average weight in private assets, so that's not publicly listed stocks or bonds, 37%.
Staggering.
I thought that was amazing too. A lot of private assets, which I would be scared to touch.
So it could be venture capital, private equity,
infrastructure, all
direct
that.
ownership in infrastructure.
Yeah, but the problem, I mean, it's not a problem because it's part of the reason you expect a higher return, but it's illiquid and it's mark to market. So when we're talking about returns for these things, a lot of it is mark to market, not realized return.
Exactly, a non-traded return.
Right. So it's kind of scary, but whatever, I guess. So big chunk in private assets. Average MER, 0.53%.
Expense ratio.
So, I mean, I guess lower than the mutual fund industry still. A little bit more assets.
Yeah, but like the CPP is still hovering on 1%, which is so high for such a massive portfolio. And they used to be all indexed, I believe, a number of years ago. And I remember Andrew Coyne wrote an article, which we should dig up for the show notes, talking about how that has shifted over time and how their expenses have gone up dramatically.
Yeah, I think the article was titled "CPP's Active Management Strategy is a Crock." It's pretty. Yeah.
Let's dig it up.
Yeah, we can find it. So CPPIB is the largest fund, and it does have the highest MER of all these funds. So the biggest one has the highest expense ratio.
And the highest amount in private assets.
48% of the CPPIB is in private assets. Staggering, really is. Interestingly, and this doesn't necessarily mean anything, but it is still interesting, Hoop has the highest 10-year return at 9.5% per year on average, and it also has the lowest expense ratio at 0.29%. It also has the lowest amount in private assets at 25%. So best returns, lowest expenses, lowest amount of private assets. Does that tell us anything?
Highest U.S. equity, maybe, if you look underneath the covers?
I didn't dig into it that far. Possibly. Now, just as a point of interest, the Canadian couch potato, 75% equity, 25% fixed income portfolio over the same 10-year period, returned 6.41%.
So that's a simple 3-index fund portfolio.
3-index fund portfolio with expenses of 0.15%, 15 basis points. Comparing that to the much more complex pension investments that have all the private stuff and a higher expense ratio, and the return has been actually the same, which is, it is what it is.
And that's the question I got today from someone saying, like, now that my net worth is getting to a certain level, isn't there more than this index strategy? Like, isn't there other stuff that we can do?
Sure, there is. Yeah, you can try it, but you never know what you're going to get. And when we're talking about these big institutions and we're talking about private investing with them, they can really get a nice cross-section of the private equity markets. Whereas if you're a person, you're either going to go through a fund where you're going to pay a ton of expenses, or you're going to make a couple of investments where you're going to maybe get a good result, maybe not on average, who knows.
Plus, if you've got something hot, are you going to go to some individual investor or are you going to go to a big pension fund?
Yeah, well, that's one of the challenges, right? When we look about...
deal flow must be so hard as an individual.
For sure. We look at venture capital returns, and the skewness is insane. I found one chart from Correlation Ventures, which is a data-driven VC firm. But they looked at 21,640 transactions between 2004 and 2013. And these are only realized transactions. So that's, they're looking at going out of business, being acquired, or going IPO. So out of those 21,640, the returns were between 0 and 1x. So that's either you're getting your money back or you're losing everything. 65%. 65% of the 21,640 venture investments were either 0 or 1x. So yes, you can get good returns, but more than likely you're going to lose. You're going to lose or not gain anything. The other big bucket there is 1 to 5x return. So you're getting your money back or getting 5x, which is great. if you can find it, 25% of the investments returned between 1 and 5x. And then you start getting into 5 to 10x, 6%, 10 to 20x, 2.5%, 50x, 0.4%. So yes, there are high returns out there. Are you going to get them? Probably not. And just on that thread of institutional investing versus index funds, there was another good story, and we've seen stories like this in the past. But the Carthage College, which is a university in Wisconsin with a $120 million endowment fund, they posted an 11% investment return over the last 12 months using solely index funds for their portfolio. And that outperformed all of the other endowments of all sizes over the same time period, which had a median return of 7.4%. So again, not the first time we've seen this, but index funds outperforming more complex private investments. Same old story.
Basically letting capitalism work for you. You can do it so easily and affordably with index funds. There's no reason not to.
That's it. We'll be back next week.
You bet.